Commodities headed for lower volatility. Donald Trump's re-election as American president will have a bearing on almost all markets, considering his policies have been projected as being more growth-oriented and inflationary. But this could be offset by the effects of import tariffs on U.S. multinationals. U.S. Treasury yields have been hardening in the run-up to the election, and the pressure may intensify as the picture becomes clearer on the size of U.S. government debt. Commodities are headed for lower volatility on Trump's intention of the U.S. pumping more oil, as he once again hinted in his victory speech on Wednesday when he described the commodity as liquid gold. The effects will be influenced by the Trump administration's strategic interventions in conflicts in Europe and West Asia. Trump's policies have a larger global footprint and will impact the growth-inflation dynamic in Europe and Asia. The two biggest trading partners of the U.S., the EU and China, could face slowing exports on account of retaliatory trade protection. This makes their currencies vulnerable, with the renminbi being in the spotlight. Central bankers outside the U.S. are likely to face higher resistance to interest rate cuts with their currencies under pressure. Corporate earnings could be depressed in industries such as semiconductors, automobiles, and IE, which are more exposed to U.S. tariff changes. Emerging economies will, in addition to higher trade barriers, have to deal with slowing capital flows due to rising U.S. Treasury yields and the dollar. This may lead to a reset of monetary policy across a wider group of economies. Markets have been positioning themselves ahead of a Trump victory to deploy capital in an altered global scenario. Commodities headed for lower volatility. Economies with strong domestic growth drivers, such as India, have some degree of insulation as financial markets turn more volatile with Trump's return.